I do think you're seeing that the semiconductors are starting to weaken a little bit. And my guess is we're seeing some selling pressure in those. Not only were they ridiculously overbought to the upside, but people are just taking some profits because they want to use some of that money to put into SpaceX. So my guess is that is causing some of the drop in the stock market. Yesterday, we got a very weak bounce in the S&P, but my guess is it's not just that. It's this overvaluation and these kind of bubble mentalities. In fact, we even just heard from Bank of America advising its clients to sell and take profits because there's too many similarities to the dot-com bubble. And I think that's a good warning sign as well. And investors have to be aware that there's a reason why these companies are rushing to the markets. They see that there's a window right now where investors are euphoric. That means investors are willing to pump money in at any valuation that they is sufficient, and that usually is a top signal. There's no doubt about that. There's this automatic buy the dip mentality that has been ingrained really since COVID, but arguably even since the financial crisis. We always think that, oh, the Fed will bail us out. Oh, the government will come out and do something. We've seen the president coming out and investing in stocks like Intel, which tells us that he's backstopping the market. We know he loves the market. And so it perpetuates this feeling that the markets can't lose. If you invest, maybe you'll see a dip, but within weeks, you'll be at new all-time highs, and therefore you buy into it very, very quickly. You throw in the AI euphoria, and you have a recipe for what we've seen here, which was this incredible rally in the S&P that seemed to go on forever. But the problem is, once it broke trend line, we're seeing this big pullback and retrace right now. But there's no doubt about it that it's this psychological impact of investors where we feel, because every time we've seen a drop of 10 or 20%, we see ourselves back at all-time highs, and that preconceives that notion that you just got to buy every dip, and that makes these big pops even bigger. Certainly the dollar is the safe haven. It still is, even though de-dollarization may be slowly occurring. That's a 20-year plus thing. And you're right, the treasuries are a great place. Here you have stocks declining sharply today, AI stocks getting smoked 10% off of their intraday highs, and you can get a guaranteed 4.5% plus on a 10-year yield, right, on a 10-year bond. So I do think these are places you park it, and people are buying bonds as the stock market is selling off here. Listen, very likely we have higher inflation than 4.5%. But if it's the difference between being in the dollar and I run the risk of the dollar losing, or even staying the same and my dollar just stays the same, or being in assets where if it's an AI trade, it could be down 10% today, you have to ask yourself, I could make zero on the dollar. If it holds steady, maybe it goes up 1 or 2%, or I could lose money in certain stocks. Getting a guaranteed 4.5%, maybe offsetting inflation, at least it allows me to keep my capital ready to deploy when stocks get much, much cheaper. I think a lot of this has to do with the oil premium and the pressure that that's putting on prices overall, at least in the near term. And then the fact that the economy here in the US, per the latest jobs report, has actually been pretty decent. Considering the spike in costs for businesses, we're not seeing a massive amount of layoffs. Jobless claims are pretty much at the low end of their range that they've been in for the last many, many years. And so, at least as of now, the headline economy, and I think there's a huge underbelly that's so weak and already in recession, but what the markets are paying attention to is still showing that the economy's okay and that oil's up high, which is inflationary. And then again, that creates this upward pressure on yields. Again, if the stock market pulls back, and I will say this, is that I think the whole entire economy at this point hinges on the stock market, meaning that you have the top 10 or 20% of consumers that are heavily invested in the market. As long as the market's making new highs, they don't care where prices go. They're fine. And they're the ones spending the big money. Everyone else that's below that threshold is continually struggling, and they're not really the spenders. But as long as you keep the stock market going up, they're fine. But if the stock market comes in and they pull back on the purse strings, that's where you see that potential weakness in the economy. And that's where we could see actually yields starting to come in pretty sharply. I have no cuts priced in right now for this year, but I do have a cut in early 2027 that I do think is going to happen. And the thesis here is just that at some point, I think oil does come in, but more importantly, I do think the economy does start to weaken. And I think once that stock market, and I've been anticipating the stock market rolling over for quite a little bit of time here, but I think we are in the midst of that right now based on these nasty big red S&P candles. We'll get our bounces. Of course, buy the dippers will come out, but I still think the markets are setting up for a larger decline and maybe potentially some sideways chop that doesn't allow the upper echelon to want to spend quite as readily. The moves in certain stocks and even in the S&P and the NASDAQ has been unbelievable. And if you go to the end of the dot-com era, it was just straight up, straight up, straight up. And so if we have some sort of move like that, it absolutely could be. I guess the bigger question is, do we have the same sort of environment? We still have the hype of AI stocks, but we're now starting to see issues with the software names, right? And how much debt they've taken on. We're starting to see more and more competition for AI chips, NVIDIA, ARM Holdings, Marvell Technologies. And so it seems like competition's coming very, very quickly. And if that's the case, then you do run the risk of these bigger leaders that are creating the bubble, maybe not getting any more extended than they are. So I'm going to take the under on that. I don't think in the near term we get to that 9,500 level. But again, there's always levers that the Fed could pull or the government that could always try to push this thing back up. One thing we do know is that the President Trump, he is laser focused on the markets, right? As soon as the markets go down, he comes out and says, hey, we might invest in these AI names or we're going to invest in Intel, trying to buoy the markets back up. And so it'll be very interesting here in the next few months. If we do see a downward move, what kind of levers are pulled? Does he give in to Iran and give them a better deal just to get the straits open? Because that would then create a potential rally. I mean, there's different levers that can be pulled that will pop us back up. So usually you get a sell-off in the summer before midterms. And again, a little bit of uncertainty and so forth. So I think that may be what we're starting to see now in the markets. Obviously, we'll have to keep an eye on this, but that certainly is a possibility. And then really what we need to see is what the arena looks like once we get the results of the midterms going into 2027. But I think, again, the bigger factors come down to where do these AI stocks go? How much more money can be kind of shuffled around? Because a lot of these AI stocks, give NVIDIA stock in their company and then NVIDIA will give them chips, right? This is kind of a round robin of these type of things. And as long as CapEx stays amongst these companies at $1 trillion plus, that's stimulative, right? That's as if the government is pumping $1 trillion into the economy. But at what point does it slow down? Have the software stocks started to slow down? Maybe, according to what the charts are saying. And that's the big risk there as well. So one thing that we're seeing is that when oil bounces, markets don't go down much. And then when oil falls, usually markets rally. The markets have slowly become immune. Like the president was like, hey, 3 days, we're going to hopefully have a deal with Iran. Well, we've heard that 100 times by now. And at some point, the market just says, oh, this is the boy that cried wolf. We'll believe it when we see it. But the question I would say is oil falling because of that news? Or is it falling because the stock market's dropping so much that maybe we're worried about the economy slowing? And that could be a bigger drawdown on what we're seeing in the price of oil. So I actually still have oil price to go lower here. We should be headed down to about $80 to $79 a barrel here on crude oil. So it's going to be an interesting little tidbit here, I have to say. When we've seen oil up, the stock market goes down, and then gold tends to follow the stock market. So believe it or not, gold to me, since this mega run in late 2025 into 2026, gold became let's get in gold because it's a get rich quick, and it's going to, for those of us that have been in gold for years and years and years, it's not really like that. And so it's taken on this other form of a risk asset. And until it flushes those players out and resumes kind of safe haven asset, I would think that it does trade more so with the stock market. And again, that's that risk off play, which is weirdly enough impacting gold and causing it to sell off. I think people are getting a little bit about, number one, the liquidity needed for the SpaceX, Anthropic, OpenAI things. So they're kind of some chips off the table, maybe even to allocate to those. And then also just these AI stocks. When you're seeing these intraday trillion-dollar companies dropping 10% intraday, that's shocking. Like I go back to the .com, and I mean, granted, it was a different time, but the company was $1 trillion company back then. And so you're seeing these type of moves on these names. And it does, as an investor, say, wait a minute, this volatility is scary at this point when you could see your account swing 10% intraday. And I think that's key. And then on gold, I think we're heading towards 4,100. And then if we break that, we're talking about in the 3,000 range, gold could be headed. But I look at that and I say, and I hope everyone out there watching says, this is great because I want to buy more gold and I want to personally buy more gold. And so let come in and then it can go to $10,000. But I would like to buy some more below 4,000. Sure. For me, on a technical basis, we are now entering a very key support level between 66 and 64. If it holds, awesome. If it breaks, honestly, likely down to 54, maybe even sub $50 silver. And I think, again, there's this even number at 50 where you'll have a lot of stops. So a lot of people will throw in the towel there. And that's usually the time when me as a buyer wants to step up and say, all right, everyone's given up on silver. Now I start accumulating. I always love to invest in things that people hate, right? And so for me, it's like General Mills, like soaring. No one likes it, pays a 7+% dividend. So it's telling me I'm going to get 7%. If it doesn't move an inch, it's giving me 7%. I mean, General Mills, and again, they make snacks, they make all this stuff. And those are the signals I want to see. I want to see money is going towards the safe haven. That's the same as buying, to me, buying General Mills is like the bonds, right? Is buying safe haven assets. And I think we're up for a bigger pullback here after, 35% run in the NASDAQ. A 10% decline makes sense, maybe a 15% retrace. And so these are the types of names, this ConAgra, other names like that. I'll hang out in those, make my dividend payments, even if they don't move. And then I can be ready to sell those and move back into riskier assets like silver at 50, like gold when it gets down enough, or even some of the AI stocks when they drop enough.